The market has been going through an immense amount of volatility, 3% down one day and 3% up one day due to two countries expected to go to war near the North Pole. There are many companies that are absolutely unrelated to all these global events. They are also crashing 4-5%. This video is not about that. Here I tell you the reasons for India's growth, what kind of returns India can have, and what kind of returns you should expect as an investor if you invest in Indian equity markets for the next 5 to 10 year period. Watch till the end. I have no doubt in my mind that this decade belongs to India. Let me start by telling you why. India has the largest number of people going to work. In the sense, India's workforce is the highest in the world. This can lead to a lot of positive things, right from increased disposable income in your hands, that can lead to consumption boom, that can lead to correlated sectors doing very well. Favorable demographic is one of the main reasons why India can become the third country to achieve a $10 trillion economy over the next decade. I'm sure you have all read through the fine prints of the budget. The clear focus, in my opinion, has been to improve the infrastructure of the company. The other area of interest for the country's FM is to make sure that the CAPEX cycle, which is right now stuck, starts very soon. The government itself has been putting in a lot of effort to up the CAPEX cycle, and I'm pretty sure over the next 1 year, a lot of these industrialists sitting on the sidelines will start setting up factories which can lead to good amount of revenue generation for the banks plus employment creation for those skilled laborers. Though the agri sector's contribution to Indian GDP is slowly on the decline, which is close to about 20%, one interesting fact to note is that it contributes close to 40% of employment. Therefore, it is important that India's agri sector grows through a different kind of a transformation. What I really like is the fact that farm income is on the rise, crop acreage is on the rise, crop production is going up. This can lead to disposable income in the hands of farmers. I'm sure you've all heard about Jan Dhan, Aadhaar and Mobile Trinity. This can lead to a lot of financial inclusion. We are already midway into it, and I should commend the entire agencies for doing a great job on it. Just remember, when was the last time you went to a broker to open an account? When was the last time you booked a general insurance policy by talking to a broker? Today, everything is moving online. And that is the reason why I strongly believe higher financial inclusion can lead to better GDP growth. Finally, everyone has been complaining that the Sensex rally doesn't show the reality of the economy, which is very true because I think only about 6,500 companies are listed out of 1.3 million companies in India, which is hardly any percentage. I believe over the next decade or so, a lot of formalization of economy will happen. A lot of these startups and companies in the MSME space will come and get themselves listed, leading to formalization of corporate sector. There are two main benefits of it. One, it can help you as an investor to identify a lot more companies than the only 6,500 companies that you have. And for those companies in the MSME space, it can lead to cheaper cost of capital. I would like to thank Ambit for sharing an absolutely wonderful newsletter on why $10 trillion for the Indian economy. Now you may say, okay, India can end up becoming $10 trillion, but what are the kind of growth rates that we need to have to become $10 trillion? In the next slide, I come and tell you the past growth rates and what kind of scenarios can evolve based on those growth rates that we expect out of Indian economy this time around. Let's see the past nominal GDP growth over the last 5 or 10 year period. Between 2007 till 2016, every 5 years, our growth rate has been between 13, 14 or 15%. What is a nominal GDP, you may ask? It is nothing but India's real GDP growth plus inflation. We've been able to grow at anywhere between 13 to 15% in the last 5 or 10 year period. I've tried to project the numbers of India's GDP by giving it between 12 to 15%. And I also tried to understand how long it will take the current GDP of $2.8 trillion to touch $10 trillion. So if you could actually see, the time taken can be anywhere between 10 to 11 years to about 13 to 14 years. So now we come to the most important part of the presentation, where what should you as an investor expect from the India's GDP growth. Let me give you a scenario. Assume that India is a large corporation with a lot of subunits, states being subunits, India being the largest corporate. And India as a corporate can grow at 12, 13, 14, 15%. Let's assume you identify 1 or 2 or 10 different companies which are fairly better managed than India and can grow at anywhere between 15 to 18% or so. All I'm saying is your growth rate is going to be 3 to 5% higher than India's growth rate, right? There are many companies that can execute far better than India, and therefore I think 15 to 18% kind of a growth rate is quite sensible. And if that scenario of 15 to 18% growth pans out, let's see how that will impact your portfolio in the slide that I'm going to show you now. Let's assume that you start with an investment of 100, okay? And you hold on to it for about 10 years only, right? The value can be anywhere between 4 to 6 times. As you can see, the value of rupees 100 can end up becoming 400 at the end of 10 years if the portfolio growth rate is expected to be about 15%. Now, as I showed you in the past, 15% was possible for India itself, right? If you can identify good growth companies that can use the capital again and again and again and then generate 15 to 20% kind of a growth rate, you can easily make anywhere between 4 to 6 times your invested capital over the next 10 years or so. Now you may ask saying, okay, wonderful, I like the India story. I like the story of investing in companies that are better than India. What should be my strategy? First, and the most important, invest in high quality, consistent growth companies or funds that invest in high quality companies. If you invest in growth companies but which are low quality, it may not translate to portfolio returns. We have a lot of things that are going to happen in the next 5 years, be it election, be it war, be it Fed rate hike. But then your minimum holding period should be 5 years for you to see decent return from the portfolio. If there is volatility, which I'm sure is going to be, use the opportunity to buy every time there's a big dip. Use the current dip also to buy. The thing about investing is that it is never buy, shut and forget. No, you need to keep a close eye on the corporation, on the fund that you're investing your money with. And also keep a very close eye on the government's narrative. Keep looking for all these high frequency indicators which tell you the real story of India's growth. The day you spot some faltering, you should also look at exiting the portfolio. As I said, execution is the key. If the government or the company that you invested in started faltering, you should just sell out come what may. Guys, I'm very sure of India's growth story. I see a lot of positive on-ground activity wherever, whichever state I go to, whichever person I talk to. I'm pretty sure you're also seeing the same. Just stop watching those media which are going to give you biased reports. Of course, there's going to be volatility. Equity is supposed to have volatility. At any given point in time, you can lose up to 15% of your capital. If the volatility is accompanied by returns, I think that is your way forward. You should invest in India's equity if you have anywhere between 5 to 10 year kind of a time horizon. I hope you like this video. Good luck.